Demerger. Okay, now let's learn about demerger in simple words. A demerger is when a parent company divides its divisions into smaller dependent or independent companies. But why do they demerge? See, a company splits itself to focus on its core business and sell off its non-profitable segment to another company, or to merge it with another company. Now, after the demerging process, the parent company is called the demerged entity and the divided part of the company is called the resulting entity. There are several types of demergers. But wait, before we see that, let's look at its benefits. Generally, when there's demerging news, the stock price starts increasing. This can provide great benefit to the shareholders. Also, shareholders enjoy stock splits, that is, buying 2 shares for the price of 1 based on the demerger ratio. This transforms the shareholders into a completely new investor in a newly formed entity. But always keep a watch on the growth potential of the newly formed entity if you're an investor. Now let's see the type of demergers. The first one is split up. A parent company with multiple businesses decides to split into 2 or more entities, usually because they have a lot of debt. In this case, shareholders are offered a chance to exchange their shares from parent to the subsidiary. But they have to pay an extra amount for this exchange. Also, the parent company remains as a separate entity. Now let's look at an example. We would have come across a demerger split up that buzzes on our newsfeed. As we all know, Vedanta Resources is a London-based company and its subsidiary is Vedanta Limited. Now Vedanta Limited has demerged into 5 subsidiaries, namely Vedanta Power, Vedanta Steel and Ferrous Metals, Vedanta Oil and Gas, Vedanta Aluminum and Vedanta Base Metals. While the name Vedanta will remain the same for one of the 6 companies, the company Vedanta Limited will be an entirely new company from its original parent. Vedanta has a debt of $3 billion which is allocated to its subsidiaries according to the Companies Act. The second one is spin-off. Here, the parent company separates a part of its operations into a new entity and then distributes the shares of this new entity to its current shareholders as a dividend. Even here, existing shareholders will own 2 shares of separate companies instead of just 1. After the spin-off, the subsidiary is completely separated from its parent company and the management control transfers to shareholders. We can understand this better with a recent example. In July, ITC wanted to separate its hotel business with 40% shareholding. Now ITC Hotel's sole focus is on the hotel business, with the confidence that government will invest more in hospitality industry to attract more tourism and create a favorable demand for the hotels industry. By following this approach, ITC Hotels will enhance its growth potential as it can actively pursue acquisitions and establish new partnerships while operating independently. Now let's see the final type, equity carve-out. Here, the parent company sells a portion of equity shares and creates a new entity. This newly formed company is now taken public to new investors through IPO. However, this idea could be misleading to the existing shareholders. Think that you're a shareholder and part of your shares gets sold to a new investor for the company's betterment. So what happens now? Eventually, the company does not give shareholder benefits, share price may crash and it can lose the parent company's value. But instead, the company proceeds to demerge, which benefits the shareholders greatly. For example, Reliance Industries decided to take Jio Financial for IPO in 2021. The share price started to crash significantly since there was no benefit to the existing shareholders. They called off the IPO and demerged, which benefited the shareholders with 1:1 ratio. It's always crucial to stay informed when a company goes through a demerger and pay close attention to the demerger ratio as well. So make wise investment decisions. If you have any questions, leave it in the comments below and do follow Zebu for more such awesome contents. See, when a company splits itself, a company splits itself to focus on its core business and sell off